depreciation looks simple on the surface. Spread the cost of an asset over its useful life. But the method you choose is an accounting policy decision governed by IAS 16, and it has a direct, compounding effect on profit, asset carrying amounts, and key ratios year after year. In this episode, we put straight line and reducing balance head to head so you understand not just the numbers, but the reasoning behind each approach. IAS 16 paragraph 60 is the governing principle. The depreciation method shall reflect the pattern in which the asset's future economic benefits are expected to be consumed by the entity. That single sentence rules out picking a method for tax convenience or because it is what you have always done. The method must match economic reality. IAS 16 also requires that the method, the useful life, and the residual value are all reviewed at each financial year end, not just when the asset is first recognized. Both methods start from the same inputs: cost, estimated residual value, and useful life. Straight line divides the depreciable amount evenly across every period, producing a constant annual charge. Reducing balance applies a fixed percentage to the carrying amount at the start of each period, so the charge is highest in year 1 and declines every year thereafter. The total depreciation recognized over the asset's life will be the same under both methods, but the timing is very different. Let us run a single asset through both methods. A piece of manufacturing equipment costs 300,000 Rand, has an estimated residual value of 30,000 Rand, and a useful life of 5 years. Under straight line, the depreciable amount is 270,000 Rand, giving an annual charge of 54,000 Rand every year for 5 years. Under reducing balance, we will use a rate of 40%, chosen to approximately consume the same depreciable amount over 5 years. Year 1 charge, 40% of 300,000 is 120,000 Rand. Here is how the annual depreciation charge compares across all 5 years. Year 1 under straight line is 54,000. Under reducing balance, it is 120,000, more than double. By year 5, reducing balance has dropped to just under 10,000 Rand. The total under straight line is exactly 270,000. The reducing balance total over 5 years comes to approximately 262,000, leaving a small residual balance that in practice is adjusted in the final year or absorbed when the asset is derecognized. This front-loading is the defining characteristic of reducing balance. Now let us post the journal entry. It is the same structure regardless of method, only the amount changes. We debit depreciation expense in the income statement and credit accumulated depreciation on the balance sheet. The asset account itself is never touched. The credit sits in accumulated depreciation, which is netted against cost to give the carrying amount. At the end of year 1, the straight line carrying amount is 246,000 Rand. The reducing balance carrying amount is 180,000 Rand, a 66,000 Rand difference already after just 1 year. How does the depreciation charge flow through the financial statements? It hits the income statement as an operating expense, reducing profit before tax. That reduced profit flows into retained earnings via the statement of changes in equity. Meanwhile, the accumulated depreciation balance on the balance sheet grows, reducing the net carrying amount of the asset. There is no cash flow. Depreciation is added back in the operating section of the cash flow statement when you reconcile profit to cash from operations. So when should you use each method? Straight line fits assets where economic benefits are consumed evenly over time. Think office furniture, buildings, or software licenses. Reducing balance suits assets where the majority of economic utility is delivered early, with higher maintenance costs in later years offsetting the lower depreciation charge. Classic examples are vehicles, certain plant and technology equipment. IAS 16 does not rank the methods. It requires professional judgment anchored to the consumption pattern. Changing the method is a change in accounting estimate under IAS 8 applied prospectively, not a restatement. 3 assumptions drive both calculations, and all 3 must be reviewed annually. First, useful life, how long the entity expects to use the asset, not its physical life. Second, residual value, the estimated proceeds at end of use in today's prices. Third, the depreciation method itself. IAS 16 paragraphs 51 and 61 require that if expectations have changed, the carrying amount is depreciated over the revised remaining useful life using the revised method from that point forward. In practice, many preparers set these assumptions on day one and never revisit them. That is a disclosure deficiency and a potential misstatement. Let us look at what a midlife change in estimate looks like. Assume we are using straight line. After year 2, the carrying amount is 192,000 Rand. Management now believes the remaining useful life is only 2 years, not 3, and revises the residual value down to 0. The new annual charge is 96,000 Rand, significantly higher than the original 54,000. Notice, we do not restate years 1 and 2. We simply spread the remaining carrying amount over the revised remaining life. This prospective treatment is one of the most frequently tested points in professional exams. A few common pitfalls worth flagging. Applying the reducing balance rate to cost rather than carrying amount is a persistent error. The rate must be applied to the opening carrying amount each year. Forgetting to stop depreciating once the carrying amount equals the residual value is another classic. Some preparers also confuse the accounting depreciation method with the tax depreciation allowance. SAR's wear and tear rates are irrelevant to the IFRS method choice. Deferred tax bridges that gap. And finally, always check whether an asset has been tested for impairment under IAS 36 before concluding that a low carrying amount is simply the result of depreciation. On disclosure, IAS 16 paragraph 73 requires you to state, for each class of PPE, the depreciation methods used, the useful lives or rates applied, the gross carrying amount and accumulated depreciation, and a reconciliation of the carrying amount from opening to closing. Auditors will test whether the disclosed method is consistent with what is actually applied in the fixed asset register. A mismatch between the accounting policy note and the underlying schedules is an immediate audit finding. To bring it all together, the method you choose shapes profit, asset values, and ratios for the entire life of an asset. Straight line is simple and appropriate where benefits are consumed evenly. Reducing balance reflects front-loaded utility and results in higher charges early that decline over time. IAS 16 requires both to be grounded in economic reality, reviewed annually, and disclosed clearly. Changes are prospective estimate changes under IAS 8, not errors. Get the assumptions right at inception, review them every year, and document your rationale.